The Great AI Sell-Off, When Valuation Meets Reality. For months, the story of Wall Street has been the unstoppable rise of artificial intelligence stocks, the shimmering promise of infinite growth, faster chips, and smarter algorithms. But this week, that story changed dramatically. The Nasdaq just had its worst week since April, erasing over $820 billion in market value from AI-linked giants like Nvidia, Microsoft, AMD, Oracle, Meta, and Palantir. It was a wake-up call for a market that had started to believe in its own invincibility. A shockwave through Silicon Valley. The Nasdaq Composite fell 3%, marking its steepest weekly loss in months. The S&P 500 slid 1.6%, breaking a 3-week winning streak. For investors, the numbers weren't catastrophic, but the psychology was. This wasn't a panic over inflation or interest rates. It was something deeper. Doubt. Doubt about whether the AI rally had gone too far, too fast. The trigger came Tuesday when Palantir, one of the darlings of the AI trade, reported earnings that disappointed investors. Not because the numbers were terrible, but because expectations had become absurd. When you're priced for perfection, even good news isn't good enough. Palantir's slide rippled across the market, dragging peers with it. By Friday, Supermicro, a supplier of high-end AI servers, had crashed 23%, making it the worst-performing stock in the S&P 500 for the week. Nvidia fell 7%, AMD nearly 9%, Oracle 8.8%, and both Meta and Microsoft slipped about 4%. Collectively, the group's losses exceeded the GDP of Switzerland. And yet, this wasn't a broad-based tech collapse. Apple and Alphabet held steady, down less than 1%, while Amazon managed a small gain. The message was clear. This wasn't a rejection of technology, it was a repricing of hype. The AI bubble debate returns. Every market cycle has its moment of reflection, when investors stop asking how high can it go and start asking what is it really worth. AI stocks have been priced as if the future were guaranteed. Endless chip demand, limitless cloud expansion, and unstoppable adoption across industries. But the truth is messier. Growth takes time, hardware cycles slow, regulatory barriers rise. When Nvidia CEO Jensen Huang told the Financial Times that China might win the AI race, it struck a nerve. He later clarified that China was nanoseconds behind the US, but the damage was done. Investors heard something they hadn't heard from the AI sector in months: humility. Meanwhile, former President Trump, asked whether he feared an AI bubble, shrugged it off, saying, "No, I love AI. We're leading China. We're leading the world." It was a statement that summed up much of the current sentiment. Confidence bordering on complacency. But markets, unlike politicians, are governed by data and fear. And this week, both pointed downward. A perfect storm of uncertainty. Beyond valuations, macro conditions added fuel to the sell-off. The federal government has been partially shut down for 37 days, delaying crucial economic data releases. Investors are flying blind without the usual monthly jobs reports or inflation metrics. In the vacuum, alternative data and private surveys are shaping sentiment, and they're not encouraging. The University of Michigan's Consumer Sentiment Index fell to near record lows. The ADP private employment report showed that companies added just 42,000 jobs in October, a dramatic slowdown. And research firm Challenger, Gray & Christmas reported the highest October job cut announcements in 22 years. For a market that thrives on visibility and confidence, the absence of hard data feels like driving at night without headlights. Uncertainty breeds volatility, and volatility exposes excess. From mania to maturity, the AI trade evolves. AI investing has been fueled by a powerful narrative, one that seemed almost bulletproof. Nvidia's chips became synonymous with the new industrial revolution. Palantir promised to fuse government intelligence and corporate analytics. Oracle marketed itself as the cloud backbone for AI developers. And Supermicro rode the wave as the hardware enabler behind it all. But even revolutionary technologies must obey financial gravity. When multiples stretch beyond logic, corrections aren't crashes, they're reality checks. This week's decline is not the end of the AI story. It's the end of Act 1, the speculative buildup. What comes next will depend on execution, adoption, and profits, not just PowerPoint slides and conference call optimism. If you zoom out, the Nasdaq and S&P 500 remain up double digits year to date. The bull market in technology hasn't died, it's maturing. Investors are starting to separate AI infrastructure leaders from AI marketing passengers, those who truly enable intelligence versus those who simply advertise it. Valuations versus fundamentals. Consider Nvidia, the undisputed face of the AI boom. The company's earnings and cash flow are phenomenal, but so is its valuation, trading at dozens of times forward sales. When growth slows even slightly, that multiple can compress fast. Palantir, despite strong government contracts and its new AI platform push, faces the same problem. It's priced like a software monopoly in a sector that's still defining itself. Oracle and AMD, both crucial players, are struggling with decelerating revenue growth. Supermicro, after a meteoric rise earlier this year, may have simply outpaced demand. Investors aren't abandoning AI, they're recalibrating. In many ways, this is a healthy correction, a chance for long-term holders to accumulate at reasonable prices and for the market to rediscover discipline. The psychology of the pullback. Market corrections often say more about investors than about the underlying assets. After 18 months of relentless AI enthusiasm, fear finally returned, and with it, perspective. Professional money managers have been quietly rotating into defensive sectors like healthcare, utilities, and consumer staples. Retail traders who piled into AI names through ETFs and call options are suddenly learning that exponential charts can move both ways. In behavioral finance terms, this is a classic example of recency bias meeting mean reversion. When prices rise for months, investors project that trend forward, but all bull runs eventually hit resistance, not necessarily from bad news, but from exhaustion. Lessons for long-term investors. Number 1, valuations still matter. Even world-changing technologies can be terrible short-term investments if you pay any price for them. Number 2, diversification is not optional. A portfolio dominated by AI stocks looked brilliant in 2024. In 2025, it suddenly looks fragile. Number 3, macro data gaps amplify risk. When the economy operates without key indicators, as during this government shutdown, speculation fills the void. Number 4, corrections create opportunities. For disciplined investors, pullbacks are not warnings but invitations. The same fear that drives panic selling can produce future winners. And number 5, watch leadership rotation. Apple, Alphabet, and Amazon's relative stability this week suggests investors are favoring quality and predictable cash flow over hype. The bigger picture. This week's AI rout is not an indictment of artificial intelligence. It's a reminder that markets are human, even when the technology isn't. AI will continue to reshape industries, from healthcare to logistics to defense, but the path will be uneven, filled with corrections, consolidations, and recalibrations. Investors who mistake innovation for invulnerability will keep getting burned. Those who separate narrative from numbers will thrive. The next phase of the AI economy will be quieter but more durable. It will reward builders over speculators, cash flow over clicks, and discipline over dreams. Final takeaway. The fall of $820 billion in 1 week may sound dramatic, but it's not the end. It's normalization. Every technological revolution goes through this cycle: hype, correction, consolidation, and then genuine productivity gains. What we're witnessing is the first real stress test of the AI boom. When the dust settles, the companies that survive will not be the loudest, but the ones that deliver measurable value. The hype cycle is over. The build cycle begins. In short, the AI market didn't break this week. It simply remembered it was a market. And in that moment, amid the flashing red tickers and falling charts, reality finally logged back in.